In the news this week, investors bet central banks will be forced to delay rate cuts. The way you would tend to see this is that the more the market removes rate cuts expectations, the higher the risk of sharper rate cuts later. For fixed income in general and credit in particular, the recent data brings certainly more confusion. But to us, they do not massively change the endgame and the positive perspective for the asset class mid to long term. Growth expectations have been rebounding partially because inflation was expected to fall. Now that inflation has shown even more persistency, the chances that we switch from inflation-focused to growth concerns by the end of 2024 are higher than 3 months ago. The message we get from companies is that their optimism so far also relied on rate cuts expectations. Their demand for loans has already decreased. They show less appetite to expand and to deploy capital, which means less job creation going forward. But if rate cuts do not materialize, companies could experience a deeper impact in revenues, triggering cost-cutting and less investments. Consumer would feel the need for higher savings, resulting in low demand even for services, bringing rate cuts back to the table. Based on this rationale, long-term interest rates should stay immune to sticky inflation. This should support the demand for corporate credit in the long term.